Now in Module 4, we're going to look at recording business transactions in the accounts. We're looking at the recording process. Records of increases and decreases in specific asset, liability, shareholder equity, revenue, or expense accounts. I'd like you to think of each account as a T. An account can be illustrated in a T account form. You'll notice the account name at the top. The left-hand side is called debit, and the right-hand side is called credit. Well, that is old language, 500-year-old Venetian language. And debit, in our terms, means left, and credit simply means right. So the debit and credit procedures, recall it's a double entry accounting system. That is, each business transaction affects two or more accounts. And the recording is done by debiting at least one account and crediting at least another. And as long as the left equals the right, we will always be in balance. Now, we have debit balance accounts and we have credit balance accounts. If the sum of the debit entries are greater than the sum of the credit entries, then that account has a debit balance. So you see transaction 1 and 3 were debited, transaction 2 was credit, and the balance is a debit balance of $15,000. On the other side, if the credits are greater than the debits, then we have a credit balance, in this case $1,000. Now you recall the balance sheet equation. Assets equal liabilities plus equity. Assets are on the left-hand side of the equal sign. Liabilities and equity are on the right-hand side of the equal sign. So the rule is going to be that assets will increase on the left because they're on the left-hand side of the equal sign, and decrease on the right. Whereas liability and equity will increase on the right and decrease on the left. The opposite. So it's where you record these in the T accounts that makes a difference. Now, secondly, we take the equity, and equity increases when we sell shares. So in this case, share capital will go up. An increase would be on the right-hand side. Equity also increases when we earn revenue, and decreases when we pay expenses. So when we earn revenue, the credit side will increase. When we incur expenses, the debit side will increase. Now, we never have a reduction in revenues, so we're never going to have a debit to revenue. And we don't have, as you know, deduction in expenses, any transaction that will reduce expenses. So there will never be a credit to an expense account. So here are the rules. Assets increase on the left, decrease on the right. Expenses increase on the left, sorry. Liabilities increase on the right, decrease on the left. Equity increases on the right, decreases on the left. Revenues only go up, so they'll increase on the right. So again, assets increase on the debit side, and liability, equity, and revenue increase on the credit side. Okay? There's your summary. You basically have to memorize this. And that's how we're going to record the transactions in the business document. So we have the original entry is made by analyzing the transaction, then entering the transaction in what we call a journal, and then transferring that information from the journal to a ledger. Now, a journal is a book of original entry. In it, it's like a diary. We're going to record every business transaction as it happens, okay, in chronological order. And it discloses a complete effect of a transaction, and it helps us prevent and locate errors. This is what it looks like when I journalize. One column for the date, one column from the account title, reference I'll talk about later, debit and credit. So in this case, on September 1st, shareholders invested $15,000 cash in the corporation in exchange for ordinary shares. And SoftBite then purchased a computer equipment for $7,000. So the first transaction is debit to cash because we received cash. Now you always record the debit first. Then you record the credit. The credit is share capital. All right. Notice you indent. You don't put it close to the line like you did with cash. You move in and record the credit. The second transaction on the same date, I bought equipment. So equipment goes up. An increase in an asset account is a debit. And I paid cash for it. So a decrease in an asset account is a credit. And that's how we journalize. On January 1st, purchased a delivery truck. It paid $240 cash now and agrees to pay $180 on account. So the asset, equipment, goes up. All right. Cash goes down, credit, and accounts payable on account goes up. And an increase in the liability is a credit. So that's how we record. Now, we transfer that information to what's called the ledger. The ledger has a card for every account. Individual asset accounts like equipment, land, supplies, and cash. Liability accounts, interest payable, wages payable, and so on. Equity accounts, expense accounts, revenue, dividends, retained earnings, and share capital. Think of these as a box of cards. Each card has an account. And the standard form of that account is just this, the date. This account is cash. It has number 101. And on June 1st, there was a debit to cash as part of a journal entry. So our balance is $25,000. On June 2nd, there was a credit. So it reduces our balance. So you see we're keeping an ongoing balance here. So the accounts in the ledger give you the current balance of each account that you're using in your accounting records. Now we transfer it from the general journal to the ledger. First transaction was a debit of cash, $15,000. Recall cash is 101. So we go and get the card, cash 101, and we say September 1st, coming from general journal page 1, up here, J1, a debit of $15,000. So the balance is $15,000. The second part of that same transaction is share capital. Now, share capital is a card and it's in the 300s. So it's 311. It was just given that number. There's no reason for it. It could be 302, 304, whatever. It's 311. It comes from J1, a credit of $15,000. So the balance is $15,000. Now, this is called a chart of accounts. Every business has one. And it's simply this. If we're talking about 1,000 accounts, then the first 100s would be asset accounts. 200s would be liability accounts, equity accounts 300, revenue 400, and expenses would be 500 or 6, 7, 8, or 9. These numbers will be reserved just for the expenses. So here's the recording process illustrated. October 1st, invest $10,000 in advertising. Well, the asset cash increases $10,000. Equity increases $10,000. So the way we record that in the journal is debit cash, $10,000. Credit share capital, ordinary, $10,000. Then transfer that. When we transfer it, we call that posting. So when we post to the ledger, we go to cash, debit 10, and share capital, credit 10. Then we bought office equipment. The journal entry, debit equipment goes up. And I gave a note in this case, so my liabilities go up, a credit to the liability. And again, post to the ledger and keep an ongoing balance of that ledger. Then we receive $1,200 cash advance for advertising services that are expected to be completed. Well, when I receive money before I actually perform the service, I have a liability to perform that service. So that liability is called unearned service revenue. So therefore, in this case, I debit cash, $1,200 because I received it, and I credit unearned service revenue. And there you have the ledger cards for cash and unearned service revenue. Then I paid the rent. Well, this is straightforward. An expense is always debit. So you debit the expense, and I paid with cash, so I credit cash. Then I bought insurance. Now, if I pay for insurance, insurance will be an expense, but if I prepay it for a whole year, then it's an asset called prepaid insurance, and the asset increased. So it's a debit to prepaid insurance, and I paid with cash, so I credit cash. And I posted, and you can notice that with these T accounts, we have to add them up later, but if we had a real ledger card, we'd be keeping the balance on a regular basis. Then I bought supplies on account. Debit supplies, credit the liability, accounts payable. And then I hired 4 employees to begin work on October 15th. Now watch this. There was no transaction. This was just talk. There has been no exchange. Recall, a business transaction is an economic exchange of some sort that affects 2 accounts. This had no effect on our records. Then I paid a dividend. Well, dividends is also a debit because it reduces retained earnings, and a reduction in retained earnings is a debit. So dividends is debited, cash credited. Then I paid the employees, wage expense, salary and wages expense, debit, always debit expenses, credit cash. Then I earned revenue. Now when I earn revenue, in this case I got cash. You always credit revenue. Revenue increases equity. Equity increases on the right-hand side. So you credit revenue and you debit cash. And there are all your journal entries that we just gone through. Okay. Now the next thing is to take a look at your general ledger. We posted all of these and we have the balances here in red. So take a minute and examine them.